Only mode.
Good afternoon and welcome to the webinar hosted by the Investor Responsibility Research Center Institute and ISS on our latest report, Defining Engagement, an update on the evolving relationship between shareholders, directors, and executives. Our agenda today is to do quick introductions, review the research in detail, provide the IRRC Institute's perspective on the research, and then take your questions. In terms of logistics for today's webinar, everyone that's on the webinar as an attendee is in listen-only mode, but we do encourage your questions. You'll see a dialog box where you can type in questions, so type in questions throughout the webinar, and we'll answer those questions at the end of the presentation. Following today's webinar, you'll receive an email with a link to a replay where you can listen to the session again or forward it to others who might have missed the webinar. This report and the press release are available on the IRRC Institute website. You can see the email address there, www.irrcinstitute.org. We encourage you to share information about the report and this webinar on social media. You can find us at IRRC Research, and ISS is at ISS Insight. And you can use the hashtag #IRC Research. If you have any problems with the audio during the webinar, please contact GoToWebinar 1-800-263-6317. Our speakers today are Mark Goldstein with ISS. He authored the report and he's Vice President for Institutional Shareholder Services. He's a veteran of corporate governance issues with more than 17 years of experience, and he heads engagement research for the research department of ISS. He's also on the ISS policy board. Also on the call today will be John Lekumnik. He's the Executive Director of the IRC Institute. He's also a veteran of corporate governance issues, and he, prior to several other positions, was the New York City Pension Fund Manager. So he's got a lot of experience on asset management issues. Just a quick word about the Institute. It was established in 2005, and essentially what the Institute does is it funds and disseminates research on a wide range of issues at the intersection of corporate responsibility and the informational needs of investors. The Institute is very passionate about the research being unbiased, so you can always depend on it to be just straight facts. We also sponsor an annual research award. We encourage you to visit the website to learn a little bit about that. There's also a 5-year impact report that was released late last year, so you can get a full assessment of the work that the Institute's been doing. And of course, the research is all available at no charge. The research touches on a wide range of topics, as I'd mentioned. A listing here is just some of the most recent reports, everything from integrated reporting to executive compensation to hydraulic fracturing, mergers and acquisitions for universal investors. So a wide range of issues there. Please visit the website and take a look there. And with that, I'll hand it over to Mark, and he can run through some background on ISS as well as the full findings of the study. Mark?
Thanks, Kelly. For those of you who don't already know, ISS was founded in 1985, and we are the world's largest provider of corporate governance information and solutions to investors globally from our network of offices in 15 cities around the world. Next slide, please. So this study is a follow-up to one that we published in 2011, again, commissioned by the IRRC Institute and conducted by my team at ISS. That was the first ever benchmarking study of engagement between shareholders and corporate issuers in the United States. This time around, as was the case last time, the study consisted of 2 components: an online survey of corporate issuers and institutional investors, followed by in-depth interviews with 45 of the respondents. Next slide, please. To maximize the comparability of the results between the 2 surveys, we asked mostly the same questions both times, although we did add a few new questions this time around. Many of the same issuers and investors, and even many of the same individual respondents, took part both times. Some of the key findings of the study were as follows. First, engagement is more firmly rooted in the governance landscape. Both issuers and investors are doing more engagement, they're devoting more resources to engagement, and while they may lament the amount of time it takes up, they recognize that it can be beneficial in various ways. Now, the term engagement covers a wide variety of topics, including corporate strategy and performance, M&A, environmental and social issues, compensation, and other corporate governance topics. Next slide. Both investors and issuers generally feel that engagement is successful, but they define success in different ways, and we'll get into that in more detail shortly. And another key finding is that corporate directors are taking part in engagement more frequently, but that's starting from a very low base, and director participation is still the exception rather than the rule. Next slide. As shown in this graph, a majority of investors and a majority of issuers reported that engagement is increasing, and no investors reported that the level of engagement is decreasing. A few companies did tell us that engagement had decreased, generally because they had resolved a particular issue of concern to shareholders. But while we would expect to see some year-over-year fluctuation at a given company, depending on performance or what's on the ballot at the shareholder meeting, the overall trend is clearly toward more engagement. In our previous study, we found a barbell distribution for investor engagement frequency. What that means is investors tended to either engage often, i.e. more than 10 times a year, or not at all. But this time around, the percentage of investors who reported not engaging at all was down to less than half the level of 3 years ago. And the percentage who engaged more than 10 times was up significantly, to around half of investor respondents. Next slide. For issuers, the distribution of engagement frequency was somewhat more even last time, but once again, this time around, we saw a clear decline in the percentage of issuers who said they did not engage, and a clear increase in the percentage who said they engaged frequently. Now, we asked participants who reported engaging more frequently what factors they felt were driving the increase. For issuers, the most common answer was Say on Pay. A large number of investors also chose Say on Pay, but the most common answer for investors was that they're receiving more requests to engage. Now, of course, many of those additional requests, in fact, relate to compensation. After Say on Pay and receiving more requests, the next most common answer, especially for investors, was that they have more time or resources. As engagement increases in frequency, participants are devoting more resources to it, or perhaps vice versa. So how do investors and issuers choose their targets for engagement? For issuers, it's pretty simple. They tend to engage with their largest shareholders, who are generally big institutional investors. For investors, on the other hand, choosing engagement targets is a little more complicated. Often, investors focus on large companies or companies heavily weighted in their own portfolios. But many times, investors focus on companies with contentious issues. Perhaps a bit surprisingly, only about a third of investors said they focus on underperforming companies per se. Now, as seen in this next slide, one of the most striking differences between issuer and investor responses was seen in the answers to the question, how long does an engagement typically last? Nearly 2/3 of issuers answered a week or less, while over 60% of investors answered more than 1 month. The comments to the survey question and comments during the interviews revealed an even greater gap. For issuers, a week or less often means the duration of a single phone call, while for investors, more than a month often means a year or more. What this suggests is that issuers see each call or meeting with an investor as a discrete engagement event, while investors tend to see a particular call or meeting as part of an ongoing engagement, which may last as long as the investor continues to hold the shares, or at least as long as it takes for the engagement to yield results. Next slide. So what subjects are companies and their shareholders talking about? Investors reported that compensation and other governance issues are the most common topics of conversation, both when they initiate the engagement and when companies reach out to them to engage. Investors also reported that they frequently reach out to issuers on environmental and social issues, but that companies are less likely to initiate conversations on those topics. Next slide. On the other hand, for issuers, The most common topics of conversation were financial results, transactions, and strategy, followed by compensation and other governance topics. As with investors, issuers also reported that engagement about environmental and social issues was more likely to be initiated by investors than by companies, but proportionally fewer companies than investors reported engaging on these topics at all. So we have a few apparent discrepancies here. For example, over 70% of investor respondents reported engaging proactively on compensation, while only 26% of issuers reported engaging reactively on this topic. Meanwhile, 35% of investors reported engaging proactively on financial results, while over half of issuers reported engaging reactively on financials. On the other hand, 5% of companies reported engaging proactively on environmental issues, while 28% of investors stated that they had received requests to engage on such issues. One possible explanation for these apparent discrepancies is that the investor participants in the survey were often corporate governance or proxy voting specialists who may be more likely to engage on governance or environmental and social matters than on financial results, whereas the issuer respondents were thinking of their conversations with portfolio managers around the quarterly earnings or an upcoming transaction. But there's another possible explanation as well, and that's that a small number of companies seek to engage on environmental issues, but they do so with a wide range of investors, while a large number of investors seek to engage on compensation and also, for that matter, on environmental and social topics, but each with only a limited number of their portfolio companies. And that's in fact consistent with voting results. Most companies see their say on pay resolutions winning over 90% support, so it stands to reason that investors don't see much of a need to engage with those companies about compensation, and instead focus on the small number of companies in their portfolios where they've identified comp concerns. That being said, investors are definitely engaging on compensation more than they did 3 years ago, and that's both because they're initiating more conversations about comp and because issuers are reaching out to them more often on that topic. Next slide. Another discrepancy between the issuer and investor responses has been a majority of investors said they are engaging more often with corporate directors, while most issuers reported either the direct participation in engagement is unchanged or that their directors never take part in engagement. And again, the likeliest explanation is that the directors of a few companies are engaging with a fairly large number of shareholders. For example, directors were targeted in a vote no campaign or members of the compensation committee at a company which has failed its say on pay vote. Next slide. When directors do take part in engagement, unsurprisingly, it tends to be the chairman or lead director, or else the chair of the comp committee, who is most likely to take part. Next slide. For both issuers and investors, the biggest impediment to engagement is the time that it takes. For issuers, no other factor other than time was cited by a majority of respondents, but 40% mentioned regulatory concerns such as Reg FD. Among investors, half cited staffing concerns, and a slight majority cited an unwillingness to talk that's presumably on the part of issuers rather than on the part of their fellow investors. Investors were also more likely than issuers to say that stubbornness or unreasonable behavior or philosophical considerations are obstacles to engagement. Now, this could mean that investors truly are less stubborn and more willing to talk, or it could mean that issuers were more diplomatic in describing the impediments. It could also mean that the two sides are expecting different things from an engagement. That actually brings us right to our next slide. For issuers, overwhelmingly, what makes an engagement successful is dialogue, even if that dialogue is contentious. In fact, issuers were more than twice as likely to define success in terms of a constructive dialogue than in terms of a change to a shareholder vote. For their part, a majority of investors agreed that a constructive dialogue makes for a successful engagement, but an even larger percentage said that an engagement is successful if it leads to concrete action by an issuer, such as additional disclosure or a change in policies or practices. And investors were nearly as likely as issuers to say that a change in the shareholder vote or a withdrawn shareholder proposal would constitute success. Presumably, this is because that would mean they're getting something in return. Next slide. These different definitions of success are no doubt part of the reason that issuers were more likely than investors to say that their engagement is always successful or usually successful. Next slide. But both groups are reporting greater success in engagement than was the case 3 years ago. And although issuers reported greater success overall, investors were more likely to say that their engagement was becoming more successful or more constructive compared to 3 years ago. Next slide. So to sum up, many factors are driving the increase in engagement in the U.S. The largest single factor is the advent of Say on Pay, but engagement is also being spurred by an increase in shareholder activism and the efforts of activists to appeal to mainstream investors by highlighting concerns in areas such as compensation and board responsiveness. Issuers who want to avoid a failed Say on Pay vote or a successful activist campaign have a powerful incentive to engage and engage successfully to keep their institutional owners happily invested in the shares. Another driver of increased engagement is the idea that engagement is an important element of investors' obligation to be good long-term stewards of the assets they manage, and investors view that engagement on issues of concern as a critical means of mitigating long-term risks, particularly where investors use a passive strategy, and simply selling the shares is not an option. Because the potential benefits of engagement, when done right, are clear to issuers and investors alike, there's every reason to believe that engagement will continue to be an important part of the investment landscape for the foreseeable future.
And with that, we'll turn it over to John for some comments on what it looks like from IRC Institute's perspective. John?
Thank you, Kelly. And first, let me start, as you all heard, there's an immense amount of information in this report. It is available free of charge on our website. Feel free to download it, pass it on, tweet it, however you want to get it out there. I also wanted to thank Mark and his team at ISS. I think it's an important contribution to understanding what the reality of the world is. Engagement has become a touchstone for many, many people, and yet, absent these two studies, there is no systematic study of what the state of engagement is. We did the first study following Dodd-Frank, when engagement was almost a mantra, and people thought it was going to cure things, but no one could define it, and we helped define it. It's interesting that engagement continues to be thought of as a salutary aspect of American capitalism. Recently, for instance, there have been two very in-depth, good protocols put out for director and shareholder engagement, one by the Shareholder Director Exchange and one by the Conference Board, but those are normative. They are how expert panels think engagement should proceed. I should define it as between those focused on directors and investors. Obviously, we cover that, but focus more broadly on corporations and investors overall. But this is not normative. This is what exists today, and so it is a useful benchmark both for those groups and for anyone else looking to understand how engagement will develop in the future and what the state is today. The reason that we did this follow-up is through happenstance. I would like to claim that it was foresight, but it was happenstance. The last study, the initial benchmarking, was the last year before widespread adoption of say-on-pay votes in the United States. So this became almost like a natural experiment. What was the state before? What was the state after? And Mark has captured that. There is more engagement. There are fewer investors and corporations which don't engage at all. Say-on-pay is widely credited as the leading, although not the only, factor for that. And interestingly, it has widened out, engagement has widened out to not just encompass say-on-pay. I, along with others, had some worries initially that compensation discussions would be so intense and so widespread that they would take all the air out of the room for discussions on anything else. That apparently has not happened. The other thing that's interesting is, as much as engagement was viewed positively I think the numbers now are over 90% define their engagements as usually or always successful on both the investor and issuer side. It is even more successful now. And so if you'll go to the next slide, please, Kelly. I think that what we're seeing is, first, as Mark said, these trends are firmly in place. They are not about to reverse. The absolute amount of engagement is up, the success is up, the subject area is up, and there is either a self-fulfilling prophecy or a virtual cycle, depending on how you want to define that, that both investors and issuers are devoting more resources to engagement, so the level of professionalism of those engagements are up. As Mark said, whether that is a cause or an effect is unclear, but it does seem that there is now inertia towards engagement. Finally, I want to comment just broadly, because as Kelly said, we do a broad set of research, both academic and practitioner, capital market, environmental, social governance. And I want to put this in context of one of the major academic debates of the day. There is, as many people who are listening to this call know, I think, a hot academic and legal debate between a director-centric model of American capitalism for public company governance, and a shareholder-centric model. The reality of the marketplace is not as extreme as either of those viewpoints, and perhaps it's not as pure as either of those viewpoints. And I think what the level of engagement, and particularly the reported level of success is that companies and investors are finding ways to talk to each other and to calibrate that tension between director-centric and shareholder-centric models. I think that is a very positive trend. It suggests a certain dynamic ability to adapt by public companies, and it is not nearly as apocalyptic as the pure proponents on either side of that academic debate would suggest. American companies are not ceding willy-nilly their ability to make decisions to institutional investors who engage, but neither are directors and boards and managements ignoring that engagement. Similarly, investors are not suggesting that every time that they engage with a company, that company is somehow fatally flawed if it doesn't do exactly what they say. I think engagement is actually functioning in some very strange ways, because we put up lots of reports to say there are problems. I am pleased to report that engagement is functioning much the way the sculptors of the Dodd-Frank bill intended, which is that companies and investors are talking to each other, working out issues, and finding a high level of satisfaction with each other around the issues on which they choose to engage, and that is a very positive thing. And I will turn it back to Kelly to take questions. As I said, the report is up on the website. These slides will be up on the website. And I turn it over to you, Kelly.
Thanks, John. Now we're on to the question and answer portion of the webinar. So if anyone has questions, you can see a question box on your screen there. Just type in your question, and I can read it aloud. Also, I'm able to open up your phone line. If you'd prefer to answer your question over the phone line, we can do that as well. Just type open my phone line up, and I can do that. Looks like we already have a couple questions in the queue. Let me start off with those, and John and Mark will take a crack at them. The first one is SEC Commissioner Daniel Gallagher recently said that environmental and social proposals represent a hijacking of the proxy proposal process. Given the report's findings about the resources now going into engagement on those issues, as well as financial and compensation issues, what do you think the cost of engagement, what is the cost of engagement on those issues? Is it a problem?
I guess I'll take that since I said I had the broad view here. Um, there are many poles in the discussion of American capitalism. Commissioner Gallagher seems to regard anything that is not a quantifiable financial statement metric as not important. I think that's very much a trading efficient market theory view of companies as securities, and is the Securities and Exchange Commission. Investors, leaving aside high-frequency investors, tend to sometimes, some investors have a longer-term perspective on these issues. So if you are a trader and you don't think that, for instance, you will ever be exposed to an environmental risk for an oil company because you're not likely to own it in the future, you won't be exposed to the Deepwater Horizon at BP, or you won't be exposed to a corruption risk, or whatever the engagement topic might be. Why would you want the company to devote any resources to fixing it or engaging about it? That is one aspect. If you are a long-term investor, you tend to regard this as they'd better engage because it is an insurance policy to protect my long-term interests. So I think what you are seeing play out in Commissioner Gallagher's statements is the tension between a shorter-term trading perspective in which things which are not likely to appear directly on financial statements, be quantifiable in the short term, are dismissed as not valuable and, in Commissioner Gallagher's words, a hijacking of the process. And between those investors who believe that the securities are directly linked, the securities that they are trading in the public markets are directly linked to the companies which issue the securities, and that the long-term health of the company is something which, as a fractional owner of the company, the investors should look at. What's interesting about this study in that context is that, as I said, the engagement seems to be successful on both sides. And so what I would suggest, since some of these engagements do happen around the 1488 proxy process, companies and investors have figured out how to square that circle, perhaps not in the larger philosophical view of the world, but around a specific instance with a specific company. And again, I think that's positive.
Yeah. And I would just add to that where we see environmental and social proposals gain the most traction with mainstream asset managers, asset owners, is where those proposals are framed in terms of risks to the investment over the long term, and not merely in terms of the underlying social issues, but in terms of the potential for those issues to impact the sustainability of shareholder value over the long term.
Our next question related, at what point do you think the cost of engagement, the time and resources, will begin to affect the cost of managing the funds for the end saver or the investor? Do you see a way to avoid these costs? Cost increases as engagement expands?
Well, I suppose I can take a crack at that. I think part of engaging effectively does mean knowing when not to engage. In other words, if, for example, you're an issuer and you're, say, on pay proposals or winning 90-odd% support year after year, perhaps you don't need to spend a whole lot of time talking to your shareholders about compensation, unless you're planning to make a change and you want to run that by your shareholders before you do it. But you don't necessarily need to engage just for the sake of touching base or building a relationship. Save the conversations for when they're needed. Now, some issuers may feel differently. They may feel that the engagement will be more successful and more effective if they developed a relationship over time. But there's a balance that needs to be struck, especially when it comes to engagement during the height of proxy season, when investors may simply not have time to take the call. there needs to be a balance in terms of the timing of these engagements so that people don't feel overwhelmed and don't feel that engagement is detracting from the other responsibilities that they all have.
From the investor side, let me try and answer that as well. There are two answers. The first is it is very true that there's a free rider problem for investors to engage. If you own 1% of a company and you do something which either reduces the risk or improves the return of the company, you have borne the entire cost of that engagement but gained 1% of the total market benefit of that engagement. Now, that being said, the issue becomes one of absolute return versus relative return for the ultimate beneficiary of that investment. So if you are, investment management company X, you will not benefit disproportionately from your competitors in terms of a relative return, but the absolute return of the investment clearly has been improved. So you are doing something positive for your ultimate beneficial owners of the security. One trend that we have seen around this is the sense of collective action, particularly on environmental and social issues, but even on some governance issues, so that you see coalitions form to spread that cost amongst a larger investment base, whether it's Ceres in the U.S. or the UNPRI globally, or the Committee for Political Accountability. You see investor coalitions form around various issues to make that work. Or at Harvard, Professor Bebchuk's group that focuses on things like staggered boards. So there's some sort of cost-sharing arrangement. The final thing that the economics of engagement does is it has, quite honestly, contributed to the rise of activist investors. Activist investors take larger positions, concentrated positions in companies, and so they will benefit disproportionately from the cost, from the benefits of the engagement, even as they bear 100% of the cost. And I don't think that we have to go very far, more than one day away from any Wall Street Journal or New York Times or CNBC report to understand how important activist investors have been, whether you think good or ill of them in today's marketplace. But the reason that they exist is that there are benefits, and they have to run a concentrated portfolio to reap those benefits.
Another sort of related question, how do you feel about the position of Dan Gallagher as well as the U.S. Chamber of Commerce petition to restrict shareholder proposals?
I don't think that's the subject of this report. While it is clear that much engagement happens around shareholder proposals, there's a lot of engagement that doesn't. We already spoke about Commissioner Gallagher's view on environmental and social proposals. I think the other issue is that has been raised is what's the appropriate level of ownership to be able to introduce a proposal, and what is the appropriate percentage of vote to be able to reintroduce the proposal. I don't think we looked at that. Mark, correct me if I'm wrong, but that wasn't. That's really not the topic of this one. I will just comment that in a past life, when I was Deputy Comptroller for New York City, I was actually, and some of you on the call may remember, the aircraft carrier proposal, which tried to reform the 1488 proxy proposal process in the mid-90s. I was actually one of the 4 designated negotiators by the SEC for that, and in the end we threw up our hands and made a very small fix. So I do not suspect, I suspect there may be small fixes which both investors and issuers could agree on in the future, but I wouldn't expect to see a large proxy proposal change in the process, just as a prediction, not as a element to this report.
Our next question, a little different angle on an international angle. Engagement by multiple investors collaborating together is common in markets such as the UK, Netherlands, and Australia. Is there any data in the study that might suggest the prospects of investors collaborating more to undertake effective engagement in the US?
Well, actually, we do have some data in the survey about the extent to which investors do engage collectively, both in terms of choosing targets, getting together to choose targets for engagement, and then also to what extent investors bring in other investors once they've decided on the issue and on the particular company. So I would urge you to read further in the study, and for additional follow-up questions, feel free to contact me. I'd be happy to discuss it in more detail.
And that answers all our questions. We thank all of you for joining the webinar. Again, we will send out an email with the link to listen to a replay of this. If you have any follow-up questions, here's our contact information for John and Mark. Don't hesitate to reach out. We'd be happy to answer any questions that you might have. And thank you, John and Mark, and thank all of you for your attention today. Have a great afternoon. This ends the webinar.
Thank you, Kelly.
Thank you.